We live in a digital world. You tap your phone to pay. You transfer money without touching paper. You invest in assets that exist only as numbers on a screen. And yet, behind this invisible financial system, thousands of tons of gold sit locked in underground vaults. Why? If money is digital, if currencies float freely, if crypto is rising, why do central banks still hold massive gold reserves? Here's the mystery. Gold no longer officially backs our currencies. The gold standard ended decades ago. And yet, when crises hit, when inflation rises, when trust weakens, gold quietly becomes the center of attention again. The truth is uncomfortable. Gold reserves may no longer publicly back digital money, but they still quietly rule it. To understand why, we need to go back to the moment when gold and money were inseparable. For most of human history, gold wasn't just a store of value, it was money. Empires stamped coins from it. Trade routes were built around it. Wars were fought to control it. The reason was simple. Gold is scarce, durable, difficult to counterfeit, universally recognized. In the 20th century, the global financial order formalized gold's power under the Bretton Woods Agreement. The US dollar became the world's reserve currency, convertible into gold. Other nations pegged their currencies to the dollar. Gold sat at the top of the pyramid. But pyramids are heavy. By the late 1960s, the United States was printing more dollars than it had gold to support. Foreign governments began demanding gold in exchange for dollars. The system strained under pressure. In 1971, President Richard Nixon suspended gold convertibility in what became known as the Nixon shock. The world entered the fiat era. Money was no longer backed by gold. At least officially. After 1971, currencies floated freely. Central banks gained unprecedented flexibility to expand money supply. Debt levels rose. Financial markets expanded. Global trade accelerated. But something interesting happened. Central banks did not abandon gold. They kept it. In fact, many accumulated more. According to the World Gold Council, central banks collectively hold tens of thousands of tons of gold, representing a significant portion of all gold ever mined. If gold no longer backs money, why hold it? Because gold serves three silent roles. Reserve insurance, in case of currency instability. Confidence signal, a country with gold reserves appears financially stronger. Geopolitical hedge, gold is neutral. It carries no counterparty risk. Unlike digital dollars, gold cannot be frozen by another nation's banking system. Unlike bonds, it carries no default risk. In a world of digital money, gold remains the ultimate offline asset. Today's financial system is built in layers. At the top are central bank reserves. Below that are commercial bank deposits. Below that are digital payment systems. Most people interact only with the bottom layer, debit cards, apps, online banking. But behind the scenes, central banks manage reserves, interest rates, and liquidity. And gold remains part of that reserve layer. Why does this matter? Because digital money is built on trust. And trust depends on perception of strength. Gold strengthens that perception. When markets panic, gold prices tend to rise. When inflation spikes, gold becomes attractive. When geopolitical tensions escalate, gold demand increases. Even though we transact digitally, the psychological anchor of gold still influences monetary confidence. History shows a repeating pattern. Crisis, loss of confidence, flight to gold. During financial instability, investors and nations move toward assets perceived as stable. In 2008, during the global financial crisis, gold surged. In 2020, amid unprecedented monetary stimulus, gold again reached record highs. Why? Because central banks expanded money supply dramatically. More digital money entered the system. The more digital units circulate, the more attractive scarce physical assets become. This creates a silent feedback loop. Central banks print to stabilize economies. Money supply grows. Inflation fears rise. Gold demand increases. Gold becomes the measuring stick against which digital currency is judged. Even without formal backing, gold acts as an informal constraint. If a currency weakens significantly against gold, it signals declining trust. That signal matters, especially in global trade. In recent years, central banks, particularly in emerging economies, have increased gold purchases. Why now? Because digital finance has made sanctions and asset freezes more powerful. Foreign reserves held in another country's banking system can be restricted. Gold held domestically cannot. This has reshaped strategic thinking. Gold is apolitical money. Digital reserves are political money. As global tensions rise, gold regains strategic importance. And here's the paradox. While the public focuses on crypto and digital innovation, central banks quietly reinforce gold positions. The digital world expands. But the foundation remains metallic. Some argue that Bitcoin, often called digital gold, can replace physical gold reserves. Bitcoin shares key features: scarcity, decentralization, portability, resistance to censorship. But central banks have been cautious. Why? Because gold has thousands of years of history. Bitcoin has just over a decade. Gold's physicality is both limitation and strength. It cannot be hacked. It does not depend on electricity. It requires no network. For central banks managing systemic risk, physical certainty often outweighs digital innovation. CBDCs, central bank digital currencies, aim to modernize money. But they do not replace gold reserves. They operate within the existing system. So despite rapid digital transformation, gold's strategic role persists. Look at the numbers. Global debt levels are at historic highs. Monetary cycles are increasingly aggressive. Inflation episodes are more frequent. In response, gold purchases by central banks have reached multi-decade highs. The pattern mirrors history. When monetary expansion accelerates, gold accumulation follows. When trust wavers, gold demand rises. When digital systems become dominant, physical anchors gain importance. It's a balancing act. Digital money provides speed and scalability. Gold provides credibility and resilience. Remove gold entirely, and the system risks appearing unanchored. Keep gold in reserves, and confidence stabilizes, even if indirectly. 3 clear takeaways. 1. Gold is no longer visible, but still foundational. It may not officially back currencies, but it strengthens central bank balance sheets and supports global confidence. 2. Digital money depends on trust, gold reinforces that trust. When crises hit, gold acts as the psychological and strategic hedge behind digital liquidity. 3. The future may be digital, but the anchor remains physical. Central banks innovate digitally while simultaneously increasing gold reserves. That dual strategy reveals where real confidence lies. A final thought. We are entering an era where money is increasingly programmable, traceable, and virtual. But beneath that digital surface, gold vaults remain full. This tells us something important. Technology changes the form of money. It does not eliminate the need for trust. And for now, gold remains the ultimate symbol of that trust. The question is not whether digital money will dominate transactions. It already has. The real question is whether digital systems can ever replace the deep, historical confidence that gold provides. Or whether gold will continue to rule from the shadows, unseen, but essential. If you want deeper analysis on monetary power, global reserves, and the hidden structures behind modern finance. Subscribe and stay informed. Because understanding what backs your money, even indirectly, may be the most important financial knowledge of this decade.